What is up, Empire Builders? Welcome to episode 5 of Weekend Reads. That's right, for the last 5 weeks, we have spent one video together where we summarize not only the week of emails that I sent out, but just the week in general. And this is the 5th week, okay? Episode 5. Here's where I want to start. I've noticed way too many overly invested analysts that want to talk about the doom and gloom and it's going to fall and it's going to be so bad and it's going to take us back worse than the Great Depression. And it's getting boring. It's getting absolutely boring listening to these idiots. So here's my challenge to you. Ask them in their comments section, yeah, but what if it doesn't ever happen? And see how they respond. Only a couple different ways they can respond. Good analysts would say, well, it's a good question. I would probably admit that I'm wrong. And then that would force them to, if they had any shred of awareness, that would force them to go inside and realize, well, maybe I'm overly invested in this position. Maybe I've been building an entire brand off of doom and gloom now. Maybe it's in my best interest to continue to pump doom and gloom because I get the YouTube views and I get everyone to pay attention to me, and that's the clickbait that's working right now. And there's a lot of those, man. There's a lot of those. Going to YouTube, going to Twitter. They're all sharing the same charts. They're all talking the same shit. It's absolutely ridiculous. It's absurd. Trump is out of control. It's all going to fall. It's going to be the worst thing. Gold back standard is the only thing we can do. No, it's not actually. The market can stay irrationally passionate and irrationally out of control for as long as it wants. This could continue for the next 100 years. We might never see a pullback. That's the actual reality, because if we're playing data and what the chart's telling us in front of us versus playing emotion, then we can only judge based on what that data and what the charts are telling us in front of us. And we can look at historical data all we want. There's even a couple analysts I saw today say, you know what? I could be wrong. We might not even get this recession. And I was like, you know what? That's a good day. That's a good day that people like that can wake up. But pumping doom and gloom and oh my God, and the job numbers and this number and that number. I get all that, man. But looking for data day in and day out just to fit your bias does not make you a good analyst. It doesn't make you smarter than everybody, and it doesn't make you worthy of listening to. You could be completely toxic and it wouldn't matter, right? So another way I'd assume that they would respond, which I assume most of them would respond, something along the lines of, you're an idiot. You don't understand. It has to this. It has to that. Gold back standard this. Gold back standard that. You ever notice how a lot of these guys, they just also too happen to have a shitload of gold and metals? Or maybe they've been sitting on this position for 10, 20, 30 years. Is that really a guy you should be listening to? Do markets move that slow anymore to where you should be sitting around banking on the last 30 years that the economy's going to collapse? And then you don't even have cash to go buy shit. You can't go buy houses. You can't go do anything. So what was the point of being right if you are right? Which that's another great question to ask. What if you are right? What then? Because most of these guys have not played this through to conclusion. They just keep talking at this level, right? And it's because it's gotten them attention, it's gotten them notoriety, maybe they got some CNBC time off of it, but they haven't actually played it through to conclusion. And I've got tons of proof that would say differently in terms of there's a lot going on right now, and all that's just supposed to slam on the brakes. AI breakthroughs, we've got pre-crime technology that I'm going to be writing about this week. We've got hundreds of millions of dollars getting pumped into this tech, billions of dollars getting pumped into this tech, billions of dollars getting pumped into space travel. And you're telling me that we're just going to go back to what? Horse and carriage? That's what's going to happen? Or 2020 election's going to come around and we're going to get one of these woke Democrats and they're just going to strip away everything that uses a carbon footprint, including us and cows. And we're just going to get rid of all that, and that's going to somehow make it all better. And they're going to not fly around on their private jets or have 5 mansions or live outside of their city limits, right? Come on, dude. Spare me. So I think that what you find is a lot of people, they they talk enough about something and then they get this idea in their head and they just can't let it go. And that's true for a lot of things. That's true for a guy who likes a girl, can't let her go. Breaks his heart, can't let her go, still obsessed with her, right? How many other examples are there of that in just everyday life? So yes, that's possible. It's entirely possible and very probable, in fact. So that's where I want to start with this, is just a reminder that most of these analysts are idiots. You present the data and you get to make up your mind. Okay? And sometimes I give my opinion along the way, but for the most part, you see, I don't really do that. I've got my beliefs. I've got my opinions on what's going to happen. And I'm completely okay with being wrong. You see how different that is? Like if this goes down and it's estimated there's a 39% chance that it's going to happen August 2020, this recession, okay? If it goes down then, you'll see me say, I was wrong. And you'll also see me say, but I still prepared. But I didn't just sit around and think hopium and optimism and just nothing bad's going to ever happen to me and I just waited. No, you're going to see me say, cool, it's good I was prepared. But if I'm right, oh man, and this 2020 recession doesn't come, and idiots like Peter Schiff, who own a fund and a gold company, and they're still spouting the same bullshit, I'm going to destroy them. I'm going to absolutely destroy them. Because that's exactly what they deserve. They overly committed to a position, had zero self-awareness, and ran with something that was wrong. So they deserve exactly what comes to them. And that's what they'll get. So let's go into this. It was a short week, so it was just 4 days. So this was Tuesdays. Global central banks go negative. And I actually released a whole list of all the rate cuts for 2019 and getting some into 2018 for most emerging economies, which is basically everything outside of a G country, and even a lot of G countries I had in there. But essentially, what this is covering is Christine Lagarde is moving into be the head of the ECB, the European Central Bank. She is next in line. So she's already going out and starting to pre-seed content that aligns with her new role. That content and that position being negative interest rates are okay. It would have been a lot worse without them. And that's just simply not true. Last week, I shared some information with you guys about just how bad Japan has been with having negative interest rates since 2016. The San Francisco Fed came out and said in January that it was good. Coincidentally, right after, 4 days after, the ECB released this study that it helped with inequality, which no, it doesn't. And then 6 months later, the San Francisco Fed, that same Fed, came out and said, actually, negative interest rates in Japan have proved to be a disaster. Even our buddy Mark Carney has said that negative interest rates usually lead to war and bad economic times. ECB current deposit rate is negative 0.4. Here's a quick little chart. Most of the Eurozone is negative right now. Last week, I also rolled out the Eurozone report, which is about 15 pages, jam-packed with basically everything that's been going on, a summary of everything that's been going on since about 2008 with rate policy, with the EU. Okay, I didn't really go in too much into Brexit, which Brexit also had some updates this week. It's essentially that Boris is tried to delay and stall Parliament to fast track his decision to leave Brexit. And then they denied that, and now there's a bunch of internal turmoil going on within the parliament once again. They've had 3 years to try and figure out this Brexit deal, and it's still not there, and it's still a mess. Okay, so they should leave the EU. I think the whole concept of the EU is laughable. To have a queen and to have somebody who rules over you like a monarch is just obnoxious. And it's a very old, dated idea, okay? And that family just gets to skate around and do whatever they want. And one could argue that they are not adding positively or negatively any more than anyone else. Okay, I would argue that all day long. And if I need to shoot a video about that, I will, but we'll leave it at that for now. Also, too, I launched another article on a site, and I was promoting that all week long. So 7 hidden recession indicators. That article, I think, is very, very good. And that was launched on the site. I also published another article yesterday, which I'll talk about in just a couple minutes. Okay, over 12,000 stores could close by the end of 2019. So we've got some interesting data. As of right now, the amount of store closures in 2019 surpass 2018. So we've got still another quarter to go, and there could be a lot more store closings. Now, your 2-cent analysts will use this as a reason to reinforce their bias, saying everything is bad and the economy is slowing down and it's all going to go to hell and hold on. Well, actually, a lot of companies are just going towards e-commerce, and this is data that I don't think gets shared enough, but here are some of those data points. Oh, first, before we get into that, 3,400 new stores have opened so far this year. So 12,000 closed. Well, there could be 12,000. It's estimated by the end of the year there will be 12,000. But 3,400 have opened, so 8,000 stores closed this year. Still pretty bad, right? Last year, 4% of net sales of Costco came from e-commerce. Sales Club generated 4.7% of total net sales year ending January 31st, 2019. And BJ's, the other third, I guess you could say, warehouse-style shopping place, discount place, appointed its very first chief digital officer. Remember that in 2018, Amazon had 5% of all retail spend, or 49% of the U.S. e-commerce market. They are dominating. People are going for convenience over retail locations. Does that mean the world and the sky is falling? No. It just means that there's a pivot, and companies that are pivoting are going to benefit. Those that aren't will close. Okay? Restructuring will need to happen. But anyways, here's some more stats. Not that bad, not as bad as the last one I did, but HSBC, basically as soon as CEO John Flint was basically fired, abruptly stepped down, let's call it, they are set to cut 4,700 jobs, which is good because HSBC is in a lot of trouble. They had their hand in a lot of interesting cookie jars that now is coming, those chickens are coming home to roost. Cisco cuts almost 500 jobs in the Bay Area. North Carolina Department of Transportation had to do a couple hundred temporary layoffs to help cover costs of road repair and road damage due to hurricanes. U.S. Steel lays off 200 workers in Michigan. And this is what I'm keeping an eye on, actually. I'm keeping an eye on steel workers and steel niched market layoffs and hiring, because that one to me is very, very important. That signals jobs coming home or jobs leaving, and growth within a sector that I think is very foundational to our country. Okay, coal miners lays off 265. U.S. Steel lays off 150 of its from its East Chicago location. That's 350 people from steel, just right there. Nestle cuts 3,600 with a goal of 4,000, expected as logistics shift, aka robotics. Again, that makes sense. 13 big companies in the Bay Area cut 200 or more employees and plan to cut more by employees or plan to by the end of the year. Well, San Francisco is one of the most expensive areas in the United States to live. There's shit all over the streets. It's a kind of a joke city to me. California as a whole is a joke. Didn't they just declare the NRA a terrorist organization? But yet nothing with Antifa, nothing with their homeless. They're giving out free needles, allowing them to poop all over the ground. Hundreds of thousands of dollars spent every year now to clean up poop. You're having a resurgence of old disease and illness coming back in that is basically caused from the increase in stool in the streets. So California, you get no sympathy from me. You guys are trying to be a woke nation all on your own. It is a joke, and you know that's what you get, I guess, would be the soft way of putting that. LeClaire Ryan, which is a law firm, they actually managed quite a bit of money. Somewhere between 10 and 50 million is on the tally sheet for them. They're filing Chapter 11, which is full dismissal. Okay, so overall the numbers aren't that bad. If you look at even in the Bay Area, their unemployment rate is 2.4%. They were even talking like, okay, if this got up to 2.7%, it wouldn't be that bad. And I agree. Nestle, they're cutting people to bring in robotics, which is what they need to survive. So what would you rather have? A loss of 4,000 jobs or the whole company folds? So some of these cuts are tough cuts and tough decisions to make, I would assume. And it's because they have to continue to pivot for the best interest of the brand. Okay, next, I think we're at Thursday. China's playing the long ball. This is where I break down 3 current events going on right now. We've got the One Belt, One Road, or Silk Road project, the U.S. trade war with China, and Hong Kong protesters. So the whole thing was very interesting with Carrie Lam, with what happened with that in Hong Kong. So basically, she said that she was going to withdraw the bill. There was hidden audio that came out that she admitted that she couldn't step down even if she wanted to because Beijing won't allow her to. What else is in there? It sounded pretty authentic, and she sounded pretty stuck, to be honest. Like she really had no choice. She talked about how she couldn't go out and be in public because people would chase her down in black t-shirts and black outfits. But that's her own fault. Too little, too late is the adage there. But the withdrawal is not like some instantaneous thing, by the way, for this bill. It has to go through all this other, I guess, litigation and all these other steps before it actually is like gone. So withdrawal does not mean gone. It just means she's going to suggest that the bill is withdrawn, and then it has to go in front of like 2 other committees and multiple other decisions before it actually gets gone. All right, so yeah, that's pretty interesting, pretty shitty situation. So this was the viral image that was getting shared around the kind of the protesting and the people that are supporting Hong Kong, because Hong Kong is essentially calling on the United States to step in and help in some sort of way to restore the true democracy that Hong Kong is supposed to have for at least, I think, another 20 or 30 years in their original agreement. Next, we have the China trade war, which is in and of itself getting interesting, but you have some people with knowledge on this situation that have said things like this. We think China is neither aiming to quickly reach a deal nor trying to hit back at the U.S. as hard as it can. Deutsche Bank China economist wrote in a report. Rather, China seems to have internalized the trade war as a given fact and is trying to preserve China's economic resiliency under rising tariffs. So it's essentially like this. Take a good deal if they can get one. If not, no big deal. They're going to stay in this thing. They're not just going to rush to a conclusion or try and impulsively make a choice or a decision, which I think definitely plays into more of Trump's style with negotiating, as clearly outlined in his book, The Art of the Deal, which is written well before he had a plan of running to be a politician. So I think that they're working on their own kind of internal financial stability, and they're doing that through several different ways, but they have trimmed back on their holdings of U.S. foreign securities. You see we're at an all-time low from the beginning of this data set in May 2018. We're at the lowest point now, so that makes sense. They're cutting the amount of U.S. treasuries that they're holding. They're also pushing the One Belt, One Road initiative with Russia's help quite a bit, and they're trying to internally grow and develop, which People's Bank of China, PBOC, has already almost finished their state-backed cryptocurrency, which might be used by the central banks, the IMF. I don't know if it'll be that or the SDR or Libra project, but that's all now openly been talked about. So they've got a lot that they're working on. They've pledged $900 billion in total to the One Belt, One Road initiative. And all that's supposed to do is connect trade between Europe and Asia, which is a old trading path that used to exist a long time ago and has since been closed. And they need to rebuild the roads, rebuild the infrastructure around that. Just this last week, the Bank of China approved another $140 billion of credit for Silk Road related projects. Okay, so they are definitely sinking their teeth in and not in any rush to finish this. I hope that what we see on our end is the same thing, because we can sustain this and be just fine over enough timeline. But if tariffs, start rising to 20-25% across the board on both sides, then we will see that global recession that everyone's talking about. Okay, and then Friday, wrapped it up with we've got a total global negative yielding debt of 16 trillion, and let's talk about those negative interest rates, which Alan Greenspan last week said you're seeing it pretty much throughout the world. It's only a matter of time before it's more in the United States. We have now the central bankers and Fed trying to work out ideas to bring negative interest rates into the United States. They've been working on this all year, and it seems that their solution to this is a dual currency, which again became more popular with Mike Carney's Jackson Hole Summit talk just a couple weeks ago. So I'm not going to read through all these, but essentially what you'll see predominantly used is the word cut because rates were cut in a lot of different countries. Jamaica, Egypt, Indonesia, Paraguay, Mexico. I can't pronounce these, so I'm not going to try. Peru, Serbia, the Philippines, India, Thailand, Jordan, Hong Kong, Saudi Arabia and the United Arab Emirates, Brazil, Russia, South Africa, Ukraine. So even some G countries in here. Chile, Pakistan, Sri Lanka. Okay. And yeah, mostly they were all cutting. There was very few that actually didn't cut. Okay. And that was my point, essentially, is that you see a lot of countries cutting still, and interest rates are running out. So we were going to see a lot more negative before this whole thing's over with, okay? And that leads me to the other article that I wrote this week, which is 3 indicators that the US dollar is going to lose its global reserve status. There's been a lot of interesting things come out lately, and I break down the 3 biggest pieces or indicators that I feel are going to lead to that. And I don't know how bad that will be just yet. I don't know how much of an impact that will have on the U.S. economy just yet. We'll have to see as it gets closer and as more talk continues with that. But yeah, in the onset right now, it is absolutely being talked about and trying to be implemented. But we'll just have to see. And that's it. So you guys can subscribe and follow along with these daily emails. You just head to empirealerts.substack.com, and it is 100% free to sign up. You just put in your email address, comes straight to your inbox every single day, or you can read for free. You just click the no thanks button, and you can catch up on over 80 emails that I've sent out now since April, which I think would take you a little while. But yeah, I think that you'd learn quite a bit. If you're brand new to macroeconomy topic or economics in general, that would be a great place to start, because I do break down, some fundamental stuff like what is GDP and basic growth indicators like that throughout the emails. But you also walk away with knowing quite a bit, and in a time when most people are choosing to sit down and not play at all, that would put you ahead. And one would say that would be quite wise to make a better plan for yourself and for your family with whatever you feel is going to happen the rest of this year and through next year. So if you like this video, go ahead and click the like button. If you got something to say, comment below. And if you're brand new to the channel, go ahead and click the subscribe button, hit the bell notification. Be on the lookout. More videos dropping soon.